picture this, just imagine this scene. On one side of the room, you have your traditional value investor.
Right, just sitting there quietly with a massive stack of 10Ks.
Exactly. Yeah. Totally ignoring the daily market panic.
Yeah.
Just sizing up capital allocation in terms of like decades.
Playing the very long game.
Get the longest game. But then on the other side of the room, you have the bleeding edge of the AI revolution.
Which is just, well, chaos.
Total chaos. It's this hyper-speed, unpredictable, algorithmic force that's reshaping the global economy by the millisecond.
And when those two fundamentally opposite worlds collide.
Right. All our assumptions just fracture.
Yeah.
Everything we think we know about the future of capital, labor, human ingenuity, it all gets thrown out the window.
It really forces us to ask if patient capital can even survive in an era of microwave technology.
Yeah, and whether those old psychological frameworks from the 20th century actually hold up when a machine can process the entire internet in the time it takes you to blink.
It's a huge question.
It is, and that is exactly our mission for today's deep dive. We're exploring how to navigate the AI era using the ultimate value investing playbook.
And we have some incredible source material for this.
We really do. We're looking at a fascinating interview with Cheng Zhen of Himalaya Capital. But real quick, before we jump into how he decodes all this noise, I need to do a little housekeeping.
Go for it.
So, for you listening, to access more advanced researches, applications, and our latest published personal intelligent multi-agent deep value intelligence, welcome to explore and join deepvalues.ai community. Also, to track total market temperature, welcome to search and download iOS app Buffett Indicator from Apple App Store. And one more thing, disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel are for research and entertainment purposes only and does not constitute any investment or financial advice. Conduct your own due diligence before making investment or financial decisions. Don't forget to like this video. Much appreciated. Okay, with that out of the way, let's get into Himalaya Capital.
Yeah, let's talk about Cheng Zhen. Because to really get this, you have to understand why his perspective carries so much weight.
Right, he's not just some random fund manager.
Far from it. Himalaya Capital is actually the only outside firm that the late Charlie Munger's family trusted to manage their own money.
Which is just, that's massive. Munger was famously skeptical.
Famously skeptical, ruthlessly rational, and, fiercely protective of his capital.
Yeah, handing over the keys to an outside manager is an endorsement that practically defies his entire public persona.
Exactly. And that level of trust, it doesn't happen through slick PowerPoint presentations, right? It happens through absolute philosophical alignment.
So what does that alignment actually look like in practice?
Well, Munger really ingrained two foundational concepts into Cheng Zhen's approach. The first one is this idea of multidisciplinary mental models.
Okay, let's unpack this. Multidisciplinary meaning like bringing in other fields.
Right. Munger argued that analyzing a market purely through financial metrics is essentially intellectual negligence.
Wow, intellectual negligence. That's a strong phrase.
It is, but he believed it. He said, to understand the true underlying reality of an asset, you have to pull frameworks from thermodynamics, evolutionary biology, psychology, sociology.
So you have to synthesize all these disciplines because the real world doesn't just neatly fit into an Excel spreadsheet.
Exactly.
It's like having different lenses on a camera, right? If you only have a macro lens, you get a great close-up, but you totally miss the wider landscape.
That's a perfect analogy. You need all the lenses to see the whole picture. But a lot of fund managers claim to read widely and, think laterally.
Right. Everyone says they do that. So what took this from just a fun intellectual exercise to a philosophy rigid enough to protect multi-generational wealth?
That brings us to Munger's second pillar, the psychology of human misjudgment.
The famous cognitive biases.
Yeah, he identified a highly specific matrix of about 25 cognitive biases. Things like anchoring, social proof, commitment bias.
The stuff that's just evolutionarily hardwired into our brains.
Right, and these biases actively fight against our ability to allocate capital rationally.
So if you're managing money other people's life savings, you can't afford to fall for them.
Exactly. In a fiduciary setting, yielding to those biases isn't just a bad trade, it's a fundamental breach of trust.
So absolute rationality becomes like a moral obligation.
Yes, not just a strategy, a moral obligation.
That raises a flag for me, though. If you treat rationality as this cold, absolute moral imperative, how do you even function in normal society?
Because society is inherently irrational.
Yeah, exactly. Was Munger just operating as this walking algorithm in Los Angeles, viewing every conversation as some calculated exchange of utility?
You'd think so, but it's actually really counterintuitive. His ruthless logic led him to extreme pro-social behavior.
Wait, really? How does that work?
He applied those exact same mental models to human relationships, and he concluded that the most efficient, rational way to navigate life is to build what he called a spider web of deserved trust.
A spider web of deserved trust. I like that.
Yeah, because he recognized that friction, legal battles, broken contracts, toxic partnerships, that friction destroys wealth and time.
So fighting with people is literally just a bad investment.
Exactly. So the logical solution is to operate with such structural reciprocity that people genuinely want you to succeed.
So it wasn't altruism just for the sake of feeling good. It was almost a calculated compounding of social capital.
Precisely. Like, he donated heavily to institutions like Stanford, and he sat on local hospital and school boards in LA.
But I'm guessing he didn't just write a check to get his name on a plaque.
No, never. He analyzed what those institutions structurally lacked, and he prioritized giving them the specific value they actually needed.
So he was investing in his community ecosystem with the exact same rigor he'd apply to, like holding a stock.
Exactly. You build the web thread by thread, and eventually it catches everything you need.
Okay, so let's take that whole framework, the multidisciplinary models, the defense against bias, the patient compounding, and let's drag it into the current moment.
The AI era.
Yes. When a firm like Himalaya looks at the AI revolution, how do they even categorize it? Because the dominant narrative right now is just, oh, AI is Web 3.0,
Yeah.
or the next iteration of the internet.
Right, and Chang Jin argues that categorizing AI as just another internet is a massive analytical error.
Really? Why?
Well, the internet was undeniably a paradigm shift, but its primary function was spatial.
Meaning it just moved things.
Yeah, it moved offline commerce and communication into a digital space. But AI operates on an entirely different vector. The framework he uses compares AI directly to the Industrial Revolution.
Okay, here's where it gets really interesting. But wait, I have to push back there.
Sure.
The Industrial Revolution took the better part of a century to fundamentally alter the global labor force.
Right, it was slow.
And we watched ChatGPT hit 100 million users in, 8 weeks?
Yeah.
The scale and the speed just don't seem remotely comparable.
The speed is definitely different, but the mechanism of the transformation is identical.
How so?
Think about before the steam engine. Human output was strictly capped by physical muscle.
Right, you could only plow a field as fast as your horse could walk.
Exactly. The steam engine exponentially amplified physical capacity. It decoupled labor from biological limits.
Okay, I follow that.
So what the steam engine did for muscle, AI is currently doing for the human brain. It's an exponential amplification of cognitive labor.
Oh, wow. So the cognitive steam engine.
Yes. And the reason it's moving at lightning speed, unlike the actual steam engine, is that AI doesn't have to lay a physical track.
Because the internet already did that.
Precisely. It's layering on top of a global infrastructure that the internet already digitized. The digital tracks are laid, the cognitive locomotive is just running over them at light speed.
Okay, if that's true, and we now have this cognitive steam engine that can process millions of data points, read every 10K ever filed, and analyze supply chains instantly, doesn't the human value investor become completely obsolete?
You'd think so, but no.
But if value investing relies on finding mispriced assets, and AI can parse the data infinitely faster than a human, why wouldn't it just inherently be better at this?
Because value investing isn't a data retrieval exercise. It's an exercise in probability, ambiguity, and human endurance.
Human endurance. Connect the dots for me there.
Well, large language models, they thrive on highly structured tasks with binary outcomes.
Like writing Python code.
Right, or translating languages or structuring databases.
Yeah.
If you ask an AI to write a script, it either compiles or it crashes. It's pass or fail.
But the stock market isn't binary.
Exactly. Capital markets are entirely non-binary. A decision that is mathematically correct today might look disastrous for 5 years before it finally pays off.
What does that actually look like in practice, though, where the human beats the machine on endurance?
Look at Himalaya's position in the Chinese manufacturing giant, BYD.
Oh, the EV company.
Yeah.
Yeah.
They have held a massive position in that company for over 2 decades. And in that time frame, BYD's stock price has crashed by more than 50% on 6 separate occasions.
Wait, 6 drawdowns of half your capital.
Yes, 6 times.
That is, that's nauseating.
It is. Now imagine a machine learning algorithm programmed for risk-adjusted returns and volatility reduction.
It would trigger a stop loss and liquidate that position during the very first 50% drop.
Or the second, at best. The algorithm looks at the tape and just sees catastrophic risk.
But a human investor doesn't.
A human value investor utilizing Munger's mental models, looks past the ticker. They're out there analyzing the underlying battery chemistry, the vertical integration of the supply chain, the relentless grit of the management team.
They see the inevitable global transition away from internal combustion engines.
Exactly. It takes stubborn, contrarian human conviction to watch your portfolio halve in value and say, you know what, the market is panicking, but the factory floor tells me we are right.
And an AI just cannot replicate that kind of psychological endurance.
Not at all.
It also brings up the architecture of the AI itself. We keep hearing about the hallucination problem with these models.
Right, where they just make things up.
Yeah, and in the context of fiduciary duty, managing someone's retirement, hallucination isn't just a quirky bug, it's a fatal flaw.
Absolutely fatal.
I look at current LLMs like they're these highly eager, incredibly well-read interns.
That's a great way to put it.
When they don't know the answer to a complex, ambiguous question, they don't just admit defeat. They predict the most statistically probable string of words to please the boss, which effectively means they just confidently invent a lie.
Yeah, and that's the structural limitation of the technology as it exists today. LLMs are just advanced prediction engines.
Right.
They lack the capacity for lateral leap thinking, that uniquely human ability to connect two wildly disparate concepts to form a genuinely novel insight.
So when they hit a gap in their knowledge, they just paper over it.
Statistically bridging the gap with a plausible narrative. Yeah. And in value investing, doing that is a shortcut to bankruptcy.
Because value investing demands absolute intellectual honesty.
Exactly. You have to clearly define your circle of competence. You must know exactly what you do not know.
You can't just auto-complete your way through a margin of safety.
Perfectly said. No, you can't. So while AI is an incredible tool for gathering the data, the human is absolutely essential to judge the truthfulness of that output.
And to hold the conviction when the market inevitably starts acting irrationally.
Exactly.
So how is a firm rooted in this kind of patient philosophy actually deploying capital in the AI space right now?
It's interesting because
looking at the market, it feels entirely top-down.
Yeah.
Everyone just assumes AI is the future, so capital is blindly flooding into broad AI ETFs and literally anything with a semiconductor narrative attached to it.
Yeah, and Himalaya explicitly rejects that top-down macroeconomic guessing game.
So they don't buy the hype.
They approach AI companies strictly from the bottom up. They aren't betting on the abstract concept of, quote, the AI revolution.
What are they looking at then?
They're interrogating the fundamental plumbing of individual companies, looking for impenetrable moats and a massive margin of safety.
Which makes their recent massive position in Google so fascinating.
Right, because everyone assumes
it's because Google is a magnificent 7 tech giant and an obvious AI winner.
Yeah.
But the timing tells a completely different story.
It is a textbook contrarian play. They did not buy Google at the peak of the AI hype.
When did they buy it?
They bought it when the market was gripped by this narrative that Google was facing an existential threat.
Oh, right. When ChatGPT first launched.
Yes. The consensus was that AI was going to completely cannibalize Google's core search business overnight.
The market basically priced in the death of traditional search.
Exactly. The market over-extrapolated the immediate threat, and that violently compressed Google's valuation.
But Himalaya did a bottom-up analysis instead.
Right. They looked at the actual infrastructure. They saw the stickiness of Google's enterprise data, their proprietary tensor processing units, their massive Android ecosystem.
And running those inference queries for AI is incredibly capital-intensive, right?
Hugely capital-intensive. And that's a cost structure Google was already uniquely positioned to absorb. So the irrational market panic created this artificial discount.
So they basically bought the underlying infrastructure while everyone else was busy panic selling the narrative.
Exactly. They found the margin of safety because people were overly pessimistic.
But the source material also highlights the inverse of that, right? The extreme danger of irrational optimism.
Yes, specifically regarding the current hardware frenzy.
Yeah, everyone is looking at this staggering demand for chips, like with NVIDIA, and assuming the explosive growth curves are just going to compound forever.
And this is where understanding capital cycles becomes critical. There is a fundamental disconnect between how software scales and how hardware scales.
Walk me through that.
Well, in the software space, if you launch a new AI tool and 1 million people want it, they can access it instantaneously.
Right. The capacity scales infinitely with almost zero marginal cost.
But the physical chips required to train those models. Building a semiconductor fabrication plant takes years of permitting, billions of dollars in capital expenditure, and incredibly complex global supply chains.
You can't just spin up a new server instance for physical silicon.
Precisely. And the danger is that companies look at today's insatiable software demand and they over-extrapolate it into the future.
So they greenlight all these massive projects to build hardware capacity.
Yes. But by the time those factories actually come online, say 3 to 5 years from now, the software demand might have plateaued.
Or the algorithms might have become way more computationally efficient.
Exactly. And suddenly you have a glut of manufacturing capacity, prices collapse, and the late-stage investors get totally wiped out.
It's a classic boom and bust cycle.
We saw the exact same mechanism play out in the solar energy boom,
Oh, yeah. Massive initial demand led to rampant factory construction.
which resulted in massive overcapacity and brutal bankruptcies across the sector. AI hardware is bound by those exact same laws of physics and capital.
Man, that is a huge warning sign. I want to pivot the lens a bit here, though. Let's move from financial capital to human capital, because this was arguably the most compelling part of Chang Jin's interview for me.
It's deeply connected to everything we've talked about.
It really is. We just talked about how building hardware ecosystems takes decades of patient capital. Well, Chang Jin argues that we have to apply that exact same patient structural investing to our communities.
Yes, echoing Munger's spiderweb of trust.
Right. And he highlights a very specific paradox in Silicon Valley regarding the Chinese American community.
It's a really stark demographic contradiction.
Explain it for us.
On the engineering side, the Chinese American community is foundational to the tech industry. They are the bedrock of the STEM workforce, building these very AI models.
And that's largely the result of historical immigration policies, right?
Right. Policies that selected for highly specialized technical skills, combined with a very deep cultural emphasis on educational stability.
So they are building the infrastructure, they're writing the code, filing the patents.
Yes. Yet, when you look at the executive suites, the corporate boardrooms, the venture capital partnerships, and certainly political leadership in Congress, there is a massive systemic gap.
The community basically hits a ceiling.
Exactly. They are hyper-visible in the engine room and almost invisible at the steering wheel.
And rather than just writing an op-ed about the bamboo ceiling and complaining about it, Chang Jin actually applied his capital allocation framework to fix the social infrastructure.
He did. He co-founded the UCA, the United Chinese Americans Community Foundation.
And they operate kind of like a seed stage venture fund for civic engagement, right? Giving out these micro grants of $500 to $5,000 to grassroots nonprofits.
Yep.
But honestly, and I have to ask this, how does a $500 grant bridge a systemic corporate leadership gap? I mean, it sounds well-intentioned, but structurally insignificant.
It definitely seems insignificant until you look at the compounding returns of civic muscle memory.
Okay, what does that mean?
You don't bridge a corporate leadership gap by just asking for promotions. You bridge it by shifting the internal psychology of the community from essentially guest worker to foundational builder.
Changing the mindset.
Right. For example, one of the grants the UCA funded was a play about the life of Dean Lung.
Dean Lung.
Yeah.
He was the Chinese laborer from the 1800s, right?
Yes, a valet and a laborer who, against staggering odds, saved his life earnings and donated them to Columbia University.
Wow.
And his donation was the foundational capital that established Columbia's East Asian Studies program.
That's incredible. But ask yourself, why does funding a play about him matter today?
Because it changes the historical narrative.
Exactly.
When a community's dominant narrative is that they are just recent economic immigrants simply here to do a job, they act accordingly. They keep their heads down.
But when a community understands they have a deep historical legacy of foundational philanthropy in this country, it completely changes their posture.
It builds civic pride. A $5,000 grant to fund a play generates the cultural confidence required for the next generation to, say, run for a local school board.
Which builds the political capital to run for city council.
Which builds the networking soft power required to eventually maneuver into a corporate boardroom.
It is patient, long-term ecosystem investing. You are literally building the spiderweb of trust on a generational timeline.
That's exactly what it is.
Which naturally brings us to the final piece of the puzzle here.
Yeah.
The next generation. If AI is automating logic, and we need our kids to eventually navigate these corporate boardrooms and civic institutions, how do we actually prepare them?
It's the million-dollar question.
Seriously, what is the curriculum for a completely unpredictable future?
Well, the source outlines a critical two-pronged strategy. The first prong is non-negotiable. Absolute AI literacy.
meaning they have to understand the tech.
Deeply. The next generation has to understand the architecture of these tools, their statistical limitations, and how to wield them. The old cliche really holds true. AI won't take your job, but a human wielding AI absolutely will.
Okay, so they don't necessarily need to like hand code the neural network from scratch, but they need to know how to expertly prompt it and evaluate the output.
Exactly.
So what is the second prong?
A radical doubling down on the traits that cannot be automated. AI cannot replicate human empathy. It doesn't have a moral compass, it doesn't possess faith, and it cannot generate truly lateral, unpredictable imagination.
So the educational imperative is to cultivate those profoundly human characteristics.
Yes.
But practically speaking, I mean, how does a parent actually do that?
Yeah.
The interview touched on the friction between traditional tiger parenting, which is, incredibly structured and disciplined, and the more modern, exploratory American happy education model.
Right.
How do you balance those when the future economy is just this moving target?
Jing Jin synthesizes the two. Because leaning too far into rigid discipline creates a worker who is excellent at following instructions, which is exactly what AI is going to automate.
Right, the machine will always be better at following the rules.
But leaning entirely into unstructured exploration often fails to build the grit necessary to overcome true adversity.
So you need a hybrid.
The framework requires the strict discipline to build foundational habits and resilience, paired simultaneously with the psychological freedom to explore obscure interests without this paralyzing fear of failure.
Oh, I love that. You essentially need the discipline to master the rules so that you have the context to know exactly when and how to break them.
Perfectly stated. And the overarching goal isn't just to make them competitive in the labor market.
What's the bigger picture?
As technology collapses borders and tightly interconnects the global economy, the ultimate goal is to raise youth with a global perspective. Individuals who have the cultural agility to strive for a cooperative global society, rather than retreating into zero-sum ideological conflicts.
Man, let's pull the threads together here because this has been a journey. We started with Charlie Munger's mental models, the realization that true rationality requires acknowledging our cognitive biases and actively building structural trust in our communities. And then we looked at AI not as some magic oracle, but as a cognitive steam engine. It can process the data, sure, but it desperately needs human intellectual honesty and patient conviction, like holding through those massive drawdowns in BYD to actually generate long-term value.
And we also saw how that framework prevents us from getting swept up in macro narratives. It allows investors to buy the artificial pessimism in a company like Google while avoiding the capacity traps of a hardware bubble.
And most importantly, we saw how that exact same philosophy applies to human infrastructure. Using targeted microgrants to rewrite cultural narratives and build the civic soft power that future generations are going to need.
It's all connected.
It really is. You listening, remember, the tools are evolving at a speed we can barely comprehend. But the core variables, emotional control, contrarian patience, and genuine community building, those are the only things the algorithms can't replicate.
Which leaves us with a truly vital question about the future of our market. If we increasingly outsource our baseline financial analysis, our logic, and our risk modeling to AI, does the next generation slowly lose the cognitive muscle required for rational value investing?
Oh, wow. If everyone is just relying on the exact same hyper-efficient LLMs to make all their decisions?
Exactly. We could drift into a reality where the markets are entirely driven by algorithmic consensus and sudden massive hallucination bubbles.
That is terrifying.
In a world where the machines perfectly automate standard logic, the only true source of alpha left might just be the stubborn, highly flawed human being who simply refuses to plug into the consensus.
The ultimate margin of safety might just be our own human stubbornness. That is a lot to chew on. Keep questioning the consensus, keep building your own web of trust, and we'll see you on the next deep dive.